What if I told you that the single most important event for the Iraqi dinar in the last 20 years has already happened, and it wasn't a change to its exchange rate, but a silent, technological revolution deep within the core of its financial system that just reached its climax? While everyone is obsessively checking numbers on currency websites, the real game changer, the one that fundamentally alters the dinar's very capacity to function on the global stage, has been successfully deployed. The Central Bank of Iraq has just completed its full migration to the ISO 20022 system for all cross-border payments. Now, I know that sounds like complex financial jargon, but please stay with me, because understanding this is the key to understanding everything that comes next. Think of the global financial network as an exclusive club with a strict language. For decades, Iraq was outside, speaking a local dialect that the international bankers in New York, London, and Singapore couldn't easily understand or, more importantly, trust. This language barrier made every transaction slow, expensive, and shrouded in a fog of suspicion, which kept the Iraqi dinar isolated and trapped within its own borders. The ISO 20022 standard is that universal language. It's the same precise, data-rich, transparent language now used by the world's major economies like the United States, the United Kingdom, and the European Union. By adopting it, Iraq isn't just learning a few new words, it's undergoing a complete financial brain transplant. This move shatters the primary technical excuse that international correspondent banks have used for years to avoid dealing directly with the Iraqi dinar. It's the equivalent of Iraq receiving its official passport into the world of legitimate, high-volume international finance. But the revolution doesn't stop with just speaking a new language. The entire banking body had to be strengthened to handle the new pressures of the global market. In a parallel and equally critical maneuver, the Central Bank of Iraq has enforced a brutal, non-negotiable deadline for all private banks to finalize their internal capital adequacy assessment process, or ICAAP, in line with the global Basel III regulations. In simple terms, this is the financial equivalent of putting every single bank in Iraq through the most rigorous military-style boot camp. They are being forced to prove, with mathematical certainty, that they can survive a total economic collapse. Their financial models are now being stress-tested against scenarios like a sudden 40% drop in oil prices, a rapid devaluation of the dinar by 30%, or a massive bank run where everyone withdraws their money at once. Any bank that cannot prove it has enough capital to withstand these theoretical apocalypses faces severe consequences, including being forced to merge or being shut down entirely. This is not a gentle suggestion, it is a systemic purge of weakness. For the international community, this is the clearest signal possible that Iraq is serious about cleaning its own house. It transforms Iraqi banks from being seen as opaque, risky ventures into transparent, fortified institutions. The combination of ISO 20022 and Basel III is a masterstroke. One removes the technical barrier, the other removes the trust barrier. Together, they represent the final two items on a very old checklist that was presented to Iraq by powerful international bodies like the International Monetary Fund and the U.S. Treasury. For years, the dream of a globally traded dinar was impossible not because of its value, but because the foundational infrastructure was deemed unsafe and incompatible. That excuse is now gone. The Central Bank of Iraq has successfully built the digital and regulatory fortress that was the mandatory prerequisite for any future discussion about monetary reform or a change in the exchange rate regime. This is the unglamorous, hard work of financial statecraft that forms the bedrock of a modern economy. It's the laying of the railway tracks before the train of international investment can even begin to move. This is the real big update from the central bank, and it's a story of structural integrity, not speculative value, which makes it the most important story of all. Now, with this new digital fortress of ISO 20022 securing the international gateway for the Iraqi dinar, you might be wondering what is happening on the domestic front to ensure the entire system doesn't buckle under the pressure of global market forces. The answer lies in a powerful, two-pronged strategy that the Central Bank of Iraq is executing with remarkable precision, focusing first on building an unshakable financial backbone and second on enforcing rigorous discipline within the local banking sector. Let's talk about that backbone, the strategic management of the country's foreign currency reserves. While oil revenue fills the national coffers, a specialized unit within the central bank, often called the investment department, is tasked with the monumental job of protecting and growing these billions in foreign assets. This team manages a complex and prudent portfolio that includes government bonds from the world's most stable nations, strategic holdings of gold, and various other low-risk financial instruments. This is not about speculative investing, this is about creating a massive financial shock absorber for the entire economy. The prudent management of these reserves has been the critical buffer that has allowed Iraq to weather brutal global economic storms, and it has been the single most important factor in protecting the dinar from the extreme volatility that could have otherwise shattered its value in the past few years. This department provides the central bank with its essential room to maneuver, the financial firepower it needs to defend the currency's stability and maintain public finance stability. The recent, highly technical statements from the central bank about this department, filled with carefully chosen phrases like operational continuity and managing risks associated with oil revenue currencies, have caught the keen eye of international financial experts. In the world of central banking, these are not casual terms, they are specific phrases that signal deep, high-level preparations for potential market fluctuations that could accompany the monumental shift of opening up the currency to global markets. This is a clear indication that the central bank is not just passively defending the status quo but is actively preparing the ground for a stable monetary reform, strategically waiting for what insiders call the safest moment to take its most significant steps. The extreme sensitivity of the Iraqi market means that any future adjustment to the exchange rate system, whether a redenomination or a move towards a more flexible exchange rate, requires a shock-absorbent structure, and that structure is built entirely on the strength and strategic management of these foreign reserves. Simultaneously, and with equal force, the central bank is flexing its regulatory muscle domestically, issuing a sweeping series of instructions to all banks to radically improve their services and, most crucially, to prevent the collection of any illegal or unauthorized commissions from citizens and businesses. The directive is unequivocal: banks must expedite transactions, simplify account opening procedures without unnecessary hurdles, and most tellingly, accept all small denominations of the currency, treating them as valid legal tender without any discrimination. This might seem like a small consumer protection measure on the surface, but it is, in fact, a profound and symbolic order. It is a direct command to the entire banking sector to respect and validate the national currency in all its forms, which is a foundational, psychological step in building public confidence in the money they use every day. To ensure ironclad compliance, the central bank has announced that its inspection teams will conduct unannounced, surprise field visits, with strict penalties and measures for any bank that violates these rules. This powerful combination of internal strength, through the strategic management of foreign reserves, and external discipline, through the aggressive enforcement of ethical banking standards, creates a powerful synergy that fortifies the dinar from both inside and out. It shows a central bank that is acting on all fronts. It is protecting the currency from international market risks while simultaneously building trust in that very currency among its own citizens. This holistic approach suggests that the reforms are not just a list of tasks to be checked off for an international audience. They are part of a comprehensive, long-term plan to restructure the very heart of Iraq's financial sector, making it resilient from the inside out and reputable from the outside in. This is the unglamorous but absolutely critical work of building trust and stability, the bedrock upon which the future of the Iraqi dinar will be built, a future that relies not on speculation, but on the solid, unshakable pillars of disciplined investment and rigorous regulatory oversight. So, after building a new financial fortress and reinforcing it with immense strategic reserves, the ultimate question for every viewer remains: where does the Iraqi dinar go from here, and what can you realistically expect in the coming months and years? The convergence of these powerful technical and financial reforms has brought Iraq to the threshold of its most significant financial transformation in decades, signaling the end of what analysts call the forced peg era and the beginning of a carefully managed new monetary policy. The current period of a fixed exchange rate, which was officially announced to last until 2025, is now reaching its natural and planned conclusion, setting the stage for the next act in Iraq's monetary story. However, it is absolutely critical to separate the exciting, data-driven reality from the pervasive and financially dangerous myths that flood the internet. The most probable and widely discussed path forward, supported by analysis from institutions like the IMF, is not a sudden, massive revaluation that creates instant millionaires, but a sophisticated monetary reform process known as a redenomination or the Delete the Zeros project. This is a strategic tool used by countries like Turkey and Venezuela to simplify a national currency by removing zeros from overly large denominations. Here is what that would mean for the currency in your pocket. If you currently hold a 25,000 Iraqi dinar note, after a successful redenomination, it could be replaced with a new, easier-to-use 25 dinar note. The crucial point everyone must understand is that your purchasing power at the moment of this change would be identical. The value remains the same, but the number of zeros is reduced, making the currency far more efficient for daily transactions, digital payments, and international accounting. The real, long-term potential for a stronger dinar lies in what happens after this structural reset. A more stable, internationally accepted, and manageable currency could, over time, appreciate in value based on Iraq's actual economic performance, specifically the development of its oil and gas sector, the success of its fiscal reforms, and its deeper integration into the global economy. The IMF has made it clear that for any of this to succeed, Iraq must embark on a sizable fiscal consolidation, which includes curbing its massive public wage bill, mobilizing non-oil tax revenues, and finalizing the restructuring of its state-owned banks. The Central Bank of Iraq itself must continue to modernize the banking system, avoid printing money to finance the government's deficit, and support private banks in expanding their crucial correspondent banking relationships. The recent success in transitioning to a new trade finance system has already supported a decline in the spread between the official and parallel market exchange rates, a key indicator of growing stability. The key takeaway is this: the central bank's actions today are not about engineering a speculative windfall. They are about building a sustainable and credible economy for millions of Iraqi citizens for generations to come. The groundwork is fully in place, the technical hurdles have been cleared, and the financial safeguards are active. The future value of the dinar will now be determined by the market itself and the continued political and economic stability of the nation. This is the true big update, the meticulous transition of the Iraqi dinar from a restricted, localized currency to a potential and respected player on the world stage, backed by a robust, transparent, and modern financial system. This journey towards genuine stability and international acceptance is the real story, and it's a far more compelling and realistic narrative than any speculative fantasy, because it is built on the unshakable foundation of concrete action and institutional reform.